So and I'm back. Yes, I'm back actually to introduce our speakers today, who are really deep in this topic. Our first speaker is Leonid Morozovskiy, who has a really deep banking experience in recent time, and is really deeply involved in crypto area and decentralized finance, and has his own projects in this area. And like he calls himself crypto enthusiast. And our second speaker is Geray Yusifov, a serial entrepreneur, so who had several businesses in the past and several exits, and currently is also have a project, Spatium, which is related to this area and which is actually participating in global new venture challenge. And as I understood, is already kind of semi-finalist already. So we will is participating, and we hope will win this year Global New Venture Challenge. So I would like to give a stage to Leonid, and so then Geray will speak, and afterwards we will leave a time for questions, which I believe will have a lot of questions. Leonid, welcome.
Yes, thank you, Mikhail. So it's my pleasure to talk on this event. I hope that that we will be talking about will be useful and interesting for you. This topic is quite new. In terms of development, this sphere has been growing like from 2018. So it's just like maybe 2 or 3 years of the development, and the space has evolved a lot. So I'm myself kind of a finance guy. I mostly work in banking system and legacy traditional finance and in the banking institutions. But since I learned about how this fintech segment is growing, I started to learn deeper, and I thought that it actually makes sense, and a lot of efforts of people around the world are concentrated on building a whole new financial system. So I'll share my presentation. Okay. So is it visible? Okay. Okay. So what I can like summarize at the moment, that crypto is on the rise. It means that a lot of solutions being built on distributed networks, a lot of daily transactions, like you can see on this chart, a lot of interest from retail investors, from institutional investors, from people all around the globe. And Ethereum unique address chart is growing. So it means that a lot of people are opening new wallets, interact with smart contracts, trying to speculate, or maybe just use for their everyday life. So the main network that's been used in the crypto sphere is Ethereum Network. And as you can see on this chart, the adoption is growing, and the network utilization is very high, almost 100%, compared to the 10% or 5% it was in January 17. So 4 years after the Ethereum network is getting attention, it's already almost 100% utilized. What is decentralized finance? Decentralized finance is a fintech segment that is aiming to decentralize, democratize some financial operations using blockchain technology. So it means that it's not trying to build something on top of the legacy financial system, but it's trying to develop something new. So I compare the fintech built on the legacy financial systems, like on banking institutions, like Goliath, and DeFi, decentralized finance, as a David, which is fighting the Goliath and trying to oppose and trying to hit some new mechanics. And the consequence is still not clear who will win this fight, but David has a lot of ambition. So decentralized finance has a lot of ambition to actually reinvent traditional financial system from scratch. So what are the key features of DeFi? In my opinion, there are several features that actually can be attributed to the most of the projects in DeFi, despite not all of them. So that would be that the protocols that are used in DeFi trying to be permissionless, meaning that every person in the world can use the protocol without asking the permission from the central agent, from the government, from some authority or his neighbor or whatever. So actually, the protocol can be used by any human being on planet Earth as long as he has the wallet. So it leads to the censorless attribute. The censorless means that whenever the user holds the assets in the protocol, nobody can censor his transaction. It means that nobody can actually put a hold on his assets inside the protocol, and he can use freely without being afraid that some authority will put a hold on the part or his assets. This also has the downside for actually like the thieves and terrorists using these protocols as well. But it's like it's free open system, so anyone can use it. Most of these DeFi protocols are automated, so there's no paperwork at all, so they're fully digital. And as long as you interact with these protocols and get the service from these protocols, is actually fully in a fully digital way. It means that only need to execute transactions from your wallet, and that's it. So it doesn't ask your KYC or IML. It's actually free to use for everyone, and it's very easy to use for unbanked, those that cannot pass KYC IML procedures in the traditional legacy systems. And it's actually borderless. So as I was saying, people all over the world can use this protocol without asking permission, and you can actually use it from any country in the world that can be used. Traditional fintech is mostly built on the banking architecture. So these applications that you can use are actually doing the settlement in the financial system that exists today for the banking institutions. But the banking architecture is very fragmented. So like each bank, his own interface, has his own plans, own identification, own settlement. And that imposes a lot of costs, transactional costs on these operations, as we know. And sometimes they're take almost like 50 or 60% out of the revenue from financial institution that actually you transact with. DeFi is a bit different because DeFi is built on top of the distributed value networks, blockchains, like for example, Ethereum. And actually you can interact with the services that exist on distributed value networks through one wallet interface. So you can actually have one interface that holds all your assets. You can sign transactions from it for every service, for every protocol that exists on the distributed network. So it's that there are some benefits for that. There are no sign-ups. You don't have to sign up for every service that exists today. you actually connect your wallet and sign a transaction. Your sovereignty is protected, means that only you and you are holding the assets inside this wallet, and no other authority or centralized entity can actually hold the assets for you. This wallet integrates money, but not also money, not only money, but actually it can hold part of your identity. Identity meaning that your KYC, maybe some coupons, maybe some bonuses, like every asset that exists today in the world. Interacting through this wallet with these protocols is private, means that nobody from the outsiders can know whose wallet is which. And actually, despite the fact that the blockchain is very transparent and you can actually trace every transaction to the end, but for the fee for the person who wants to break your privacy, it will take a lot of efforts to actually do that. So it means that you can interact with financial system without disclosing who you are, how you work, and what amount of wealth you have. And actually, this wallet has multiple accounts, meaning that you can actually create a wallet for every transaction, for example. So it's very easy to do, and your private account, like your private key, is holding control of all the accounts inside your wallet. So the architecture is actually quite different from the banking, meaning that you only have the application called wallet, which is the UI that you have. You connect it with the JavaScript library to the application existing on the blockchain, and you can just interact with that. So it means that your UI for interacting does not change, your wallet does not change, but the decentralized application that you're interacting with can change. So you can actually switch very easily from one protocol to another. So the interface and the interaction, like the technology behind these two paradigms are quite different. Means that conventional applications have a server, an app server, and API behind it, while decentralized application existing on the distributed network has peer-to-peer network behind it and contracts as a service layer. And for storage, mostly the blockchain is used, or some distributed storage file system. Blockchain explorers actually help to ensure the transparency. So it means that if you're putting assets inside some protocol, you can actually trace every transaction that is happening inside the protocol, which gives a lot of opportunities for regulators, because they can actually trace every transaction happening on chain. They can understand if the protocol or service is solvent. It doesn't have problems with trustfulness, and actually you can find information about the volumes of transactions, about illicit transactions as well, because all of this is happening on chain. So this is a simple example how it works. It's a simple smart contract with the embedded code. So it means that not only you understand and can learn about every transaction inside the protocol, but you can understand the logic. You can into the protocol, find the smart contract, and know what features does it have inside. That was not that is the thing that was never used in traditional system. So you can never kind of go to the bank and act like find out what is under the hood. Here it's very transparent. You can understand if this protocol has some centralized features, if the founders of protocol can withdraw all the funds of the users, or they cannot. DeFi actually sees a significant growth. You can actually see that it has reached almost 37 billion worth of assets inside these protocols. Despite that, in the beginning of 19, it was just 1 billion. So it grew like 40 times for these 2 years. And a lot of interest of new people are coming to these protocols and start to use to earn value or exchange value, and this is also complemented with the market movement called as stable coins. So stable coins have been on the rise too. They've been growing a lot lately. A lot of companies are trying to issue their own stablecoins, meaning that they issue like tokenized version of the dollar itself, and even euro and pounds and so on. So basically, the blockchain space kind of like a black hole sucks in traditional assets, and it's starting from money. So the money here exists on these blockchain networks in a tokenized form as a token, and they can exchange these tokens to different assets. The most popular asset so far is the Tether token, which has 20 billion of volume of total supply on Ethereum Network, and 15 billion more on networks as well. And you can see that 2,600,000 people are trusting Tether token and hold it in their wallets. And there has been a lot of the transactions with this token, almost 92 million on the date on yesterday. DeFi ecosystem actually grew a lot with different solutions that can be seen as an alternative to traditional legacy financial system. It has alternative savings protocols. It has insurance. It has derivatives, lending and borrowing protocols, payment, staking, tokenization. So a lot of different people are creating their own solutions for DeFi. And since these protocols are composable and interoperable on one informational layer, they can interact with each other. So it means that if you're doing a payment, you actually get payment in the token that is bringing yield to the person who is receiving that. So it means that you can actually compose the protocols between each other. So I will share some basic ideas that work in DeFi, because DeFi grew a lot with this kind of set of ideas that are implemented inside these smart contracts. But the basic ideas are kind of I'll share just the two of them. So the first idea is that you can actually the market, meaning that you can take a loan in one asset, like say asset one, given the collateral to the protocol in asset B. So it means that you can actually take loans against some asset, actually receive the interest rate and pay for the asset you're borrowing in smart contract. And it's done in a fully decentralized way. So there's no single entity like a institution, like a bank that is giving the loan, but actually it's a peer-to-peer lending, meaning that people are giving money to each other, and it's just that the rate is different for the borrowing and lending inside the system. So once you don't have a financial institution that is backing these loans and kind of initiating the growth for lending of these assets, the interest rates should be algorithmic. So it means that whenever there's the growth of the supplies, meaning that the deposits are growing, but the borrowing is not, then it is going down. So it means that the rate of taking a loan is decreasing. But once the utilization of the asset is growing, it means that a lot of people are taking a loan in that asset. The interest rate is algorithmically going up. And actually, this is a brilliant idea how you can change the interest rate inside the protocol for supplying and borrowing without some governance, without the set of people who are deciding on the rates. So here the rates are fully algorithmic. You can understand and learn about these inside the smart contract, and you could actually understand if you want to borrow at that rate or you want to supply, make a deposit in that. And you just consider what's would be the financial consequences for you, and you can actually earn value from that. The money market protocols are kind of democratizing the way you can use these smart contracts by making the interest rate discovery algorithmic with a simple formula. The interest rate grows as the utilization of the asset grows. As soon as everyone are taking loans in dollars, it means that the rate of these dollars growing up. It means that those who are lending to the protocol are receiving a better rate for them. So it's a straightforward idea based on that the interest rate can be fully autonomous without any kind of centralized entity setting the rates for the users. And actually, there are a set of assets that are used in this ecosystem, like stable coins, Bitcoins, Ethereum, and so on and so on. But if we see the trend here, if you look a bit further on, we can imagine that at some point of time, many tokenized assets will appear in these protocols, like tokenized securities, Apple, Tesla, and so on, and maybe even the mortgages, maybe some equity of companies. And you can actually use these protocols in the same sense that you can collateralize them and borrow against them. The second idea that is commonly used in DeFi, these are the exchange IMMs. So these are automated market making pools that are democratizing the use of exchanges. Whenever you are going to an exchange, there's a set of rates you can buy and sell the asset to, and there are always some institutionals which have sophisticated technology to market make the market. So it means that you don't. It means that you have a small slippage in terms of converting one asset to another. But here, using our contracts, you can actually create a new idea how that can be done without the centralized entity. You imagine the pool like bucket with two assets, asset one and asset two, that are split 50-50%, and this split is determines the price at which you can sell and buy asset one to asset B, like token A or token B. If you are swapping one asset to another, the reserves inside this bucket, inside this pool, are changing, and rate of the price that is set of token A to token B is changing too. So it means that with this smart contract, you can actually create a fully decentralized, autonomous pool where liquidity providers like market makers can earn fees from the traders that swap one asset A from asset B. And again, it's fully decentralized way. It's centralized, permissionless, and nobody can stop the trades. And as soon as the reserves in one assets are decreasing, assets like the asset two in the pool is increasing, the rate of change of one asset to another is determined by the price curve, which is just like a bonding curve, multiplied by y formula. And the last thing that is rising at the moment, that the idea that you can create a company in a kind of a new digital way, meaning that your company will exist like a fully digital entity on the blockchain, with the equity on chain, with the wallet that will exist on chain. You would have all your transactions recorded inside the distributed network. It will be fully decentralized, meaning that it cannot be stopped, and actually quite transparent, meaning that every transactions that you make with this company is recorded in distributed network and can be traced by regulators. Actually, when you create such a company called the DAO, Decentralized Autonomous Organization, you can actually execute actions with these smart contracts and make a fully digital finance world. So the last idea that DeFi is kind of creating is the farming, that these protocols distribute governance tokens that govern the protocol itself to early users. So whenever you are supplying an asset in, like, for example, a protocol compound finance, you actually receive reward in the governance tokens that govern the protocol as an incentive. And you could actually sell these tokens, giving you the rate of 0.28 for lending to the protocol, and 3.92, for example, if you're borrowing the asset inside the protocol. And that is a completely new model that allows early users to get the control of the protocol itself. Like, for example, a good example would be, for example, you're setting a bank, and a lot of users are joining in, lending to your bank and borrowing money from it, and you start to distribute equity. You start to distribute control among the users that are using the protocol. So this is the basic idea behind that. That's probably it. So these are the basic ideas that I use in DeFi. And I think I will give the word to Geray to tell you a little bit more about the wallet, how the whole ecosystem of blockchain solutions has grown. Thank you.
Yeah, hello everyone. Thanks, Leonid, for this comprehensive explanation. It was great. I just want to bring some more, let's say, traditional financial services perspective to this and what's going on the traditional world and how these two worlds can be connected. So let me share my screen and I'll go through the slides. Okay. So just to begin my presentation, I found a very interesting quote today, and I think it's just kind of summarize the idea I want to communicate in this presentation. So, and the quote is that if you think about the roles that financial institutions play, blockchain removes their roles as intermediaries. In financial institutions embrace blockchain, they need to rethink their own business model and what value they bring. Otherwise, they might become increasingly irrelevant. 15 years ago, it was said that e-commerce was the future and many retailers didn't believe it. will be living in the hybrid world of centralized and decentralized systems in the next 5-10 years. I think it's a very good quote from Bin Ryan, who is from Elwood Asset Management, kind of giving an idea what's happening around the traditional finance. So the blockchain and digital assets, they kind of started to disrupt the financial service landscape. And I just bring some recent news from around the industry, kind of giving an idea of what's going on around the traditional industry and the regulations around that. So there are news from US regulators, which actually starts allowing banks to do transactions in stable coins, or actually allowing banks custody digital assets for the clients. There was like another news last week that the credit card giant Visa announced it's connecting its global payment network of 60 million merchants to the USDC, which is a stable coin created by the Circle Internet Financials on the Ethereum blockchain. And this news are coming almost every week with the big kind of developments around the traditional market and how the traditional market reacts to the development around the blockchain space. So in the 2017, 2018, kind of this crypto boom generated enough capital for the blockchain entrepreneurs to start on new advanced projects. Right now, the market has reached the point it's maturing, and it's largely supported by the institutional and corporate investors. We're reaching the point when every household will experience this world of direct transacting built on more efficient, fair, and inclusive technology. So this is an attractive entry point at the intersection of maturing technology and better choice of quality projects for use to accelerate mainstream adoption and competitive advantage. So what does digital world have to offer? And it actually passed certain kind of levels of development. The digital asset market has come a long way, just being used for purely speculations, to a maturing ecosystem with today with more than 100 million users. Until the development of stable coins, crypto wasn't the best way actually to do make payments because of high volatility. Stable coins allowed users to make instant and almost free international money transfers without intermediaries, reaching a total supply of 30 billion in a year. Such major payment processing companies such MasterCard and Visa, they start supporting digital asset transactions, not only helping crypto to access traditionals, but also traditional to access the crypto world. And the next step of development is the involvement of central banks. More than 80% of central banks worldwide are working on issuing their own central bank digital currencies, with the more than 30 pilots starting this year. Like the recent one, we heard about the digital yuan, which is actually issued in China for as a pilot project. So access to digital assets is becoming an important competitive advantage for the financial service providers. And on top of the cryptocurrencies are developing as more efficient electronic payment, crypto also is becoming increasingly popular investment asset, growing at 300% just in 2020, with the market cap reaching $1.5 trillion. The introduction of DeFi projects created a global digital market for lending, borrowing, and providing liquidity. A total value of 40 billion is locked in DeFi protocols, allowing lenders to earn interest in stable coins of up to 16% APR as of today. More investment opportunities on rise, including synthetic assets, decentralized derivatives, as well as the tokenization of real-world assets. The rapid development in digital finance disrupt traditional financial intermediaries, missing all the opportunities around this growing market, but give a huge competitive advantage to ones that implement the strategies to get involved. So just if we talk about the benefits which this space can bring to the regular customers, so I just can tell from my own example. For example, if I want to pay to my service providers who are the freelancers, for example, from the 20 countries around the world, so I don't have to actually, make a 20 wire transfers to different countries, paying commissions and waiting for the week when this money can reach or cannot reach the person I'm actually dealing with. So I can do it instantly and send the money cross-border with the speed of internet, which is much more convenient compared to the traditional financial payment system. So last week I had a discussion with Leonid. I asked, how you want me to send you 10K? He said, just send it me in USDC. I mean, people who are already in this market, they kind of understand how superior technology is. And if we start using this, it's hardly to go back and use something else, actually. So, and it's also allows companies actually raise funds in stable coins, for example, or create some contractual obligations in stable coins. So, so I can also access wide range of investment opportunities in the fast-growing market, as well as participate decentralized finance systems of financial applications that are built on the top of blockchain networks. And these protocols, they kind of implement some financial primitives like a lending, asset exchange, or liquidity providing. It was a great presentation from Leonid explaining how the DeFi ecosystem works, basically kind of powering P2P lending and borrowing protocols, which is kind of, allows people to, to get loans backed by the asset classes with the collateral ratio of 100%, and smart contracts, they automatically matches borrowers and lenders and calculate interest rate based on the ratio of borrowed to supplied assets. So this is all kind of creates a huge opportunities, and the people who are the early adopters and actively involved in the space, the people actually using the technologies as Leonid described, they are kind of benefiting from all these opportunities around the growing digital asset space, digital asset ecosystem through their wallets and their crypto exchange accounts, centralized or decentralized. However, we think that the adoption to the mainstream will come through the traditional financial institutions, which are the intuitive way for people to engage with digital assets through their existing accounts. Since mainstream is more comfortable working with trusted and regulated counterparty, which can provide them a simple and secure way of accessing the digital asset ecosystem. So the only issue is that traditional institutions need to build a connection to the digital asset ecosystem. So is there any place for the traditional financial services and what they can do? Yes, so traditional financial institutions can become a single gateway to the digital asset world for mainstream users. Currently, only regulated entities can provide high quality on-ramps and off-ramps, which can generate very high margins at this stage of development of the market. As an example, PayPal's Bitcoin revenue is expected to top 2 billion by 2023. And on top of the traditional financial services, on top of that, companies can also custody digital funds for the clients. For example, 40 banks in Germany applied for the crypto custody license just this year. Today, we had also interesting news that the PayPal is actually buying crypto custody firm Curve and the kind of custody of clients' assets will create an opportunity for financial businesses to provide additional services and sell more kind of services to their customers. And why adding digital asset service is still an issue. So cryptocurrencies are powering the decentralized finance ecosystem. Those who want to join this new world of digital finance have to be technically savvy and take full responsibility for managing their funds and private keys used for the transaction signing. So the fund custody dilemma is still the biggest obstacle for the mainstream adoption. There are actually two imperfect approaches. So what institutions can do, they can actually could give out the keys to the users, in which case users would become their own banks and they take the sole responsibility for managing their own funds. In this, customers will constantly be faced with the stress of safeguarding their private keys and seed phrases, with such solution, financial service companies would face also AML risks, and nobody controls the transactions. Another way, institutions could also hold the keys on their side. This would require additional licensing, spending a huge investment on the infrastructure, that all the funds will be kept in one place, which would actually lead to the counterpart risks and kind of defies the purpose of decentralization and limits the opportunities available for the users. So the company I represent actually working on solving this dilemma. With our solutions, banks and other financial intermediaries are instantly kind of are able to instantly integrate crypto functionality into their client accounts. So their users are able to manage fiat and crypto from a single platform and access all the opportunities around the space with just, single integration. And this is all done without having to spend a fortune to build their own digital custody infrastructure. So since financial service companies, they technically aren't responsible for the custody of digital assets, it frees them from obtaining additional licensing for digital asset custodianships. So it actually works as a bank deposit box, then the user creates and the main secret and the key and controls the funds. And then there's another secret which is generated on the financial service provider side, and both secrets need to communicate and be involved to sign the transaction. So the technology we actually created is actually allows us to provide security service by separating control over the funds from the responsibility for security. With our model, no one can access funds without the user's approval, but security is guaranteed by the professional third party. So it can be any financial service company who is actually acts as a security provider. So this is done from our proprietary multi-party computation protocol that actually replaces the private key and with the set of independent secret, and there is no single point of failure. And in case the user actually loses access to his wallet, he can restore it through our unique anonymous biometric backup functionality, which is based on neural network that encrypts your face into anonymous biometric code without storing any personal data. So you can never lose access to the wallet if you are the key. So as a bank kind of account is gateway to the traditional financial ecosystem, our B2B solution brings traditional financial institutions a regulator-friendly bridge to the crypto world through the kind of plug and play integration. And it actually allows banks to retain their traditional functions in light of AML and KYC and other internal requirements, with the benefit of not having to take responsibility for the custody of digital assets. So how the financial service companies can adapt to the digital asset world. So we think that, the blockchain geeks will continue working through the native tools, while the mainstream will be looking for the reliable partners to engage with the crypto in a secure and simple way. So we believe that growing community of decentralized ecosystems will not accept centralized entities to gain full control of their funds. So this determined the services provided and fees charged to the customer. So this kind of centralization is completely contradicts to the idea of decentralization. So we see that on the long term, the financial institutions will actually transform from the custody roles into kind of IT companies with the financial license, providing security and functionality instead. So just screenshots from our product. So what the clients of the institution can do, integrating our solution that includes trading, exchanging of any digital currency, getting access to Web 3.0 decentralized applications and DeFi services, everything just from the single platform instead of using separate wallets for the separate services. So yeah, basically that's all I wanted to share.
So are we good for some questions?
Yeah, actually, if anybody would like to ask any question, you can just unmute yourself and yeah, and ask the question. Okay, if nobody would like to ask a question, I have a question actually. So we see that really there's a lot of things going on, and there are some kind of major milestones that institutional investors joined in, and some public companies already start to invest their free cash in Bitcoin, for example. So what do you expect? What might be other milestones which will be a sign of, how to say, later adoption, and the sign that we move forwards in terms of adoption? So what might be the next milestones which we may see in the nearest future?
Yeah. So in my opinion, the next step that we can take from here is integrating the CBDC, integrating the central bank digital currencies that can be used inside conventional blockchain networks. So that would help development of the ecosystem a lot, because right now a lot of trust comes to the issuers of these stable coins that exist on these networks, but you cannot actually be sure if the issuers of these stable coins will not be insolvent in some time. So the issue of the trust still exists within these networks, and if like trusted stable coins will be integrated inside these public chains with the ability to use them inside of these decentralized protocols to make a payments, to make a lending or borrow, that will help the development of ecosystem a lot. And in my opinion, we'd see that pretty soon, and a lot of corporations will start integrating public chains like Ethereum or Tron or EOS or maybe Binance Smart Chain, trying to create a system where we'd have a lot of interoperable blockchains, where you can see a lot of assets from traditional worlds, like the current national currencies, like equity, bonds, a lot of derivative instruments from the legal system. And since we have these interoperable distributed networks, financial system might actually just change for a minute, that it will be more fair, more distributed, and actually a lot of users across the globe will get access to that system through their conventional partners that they are working right now like PayPal and Amazon and Google, it's not like it's not a visionary thing that to see that the Google integrates all these crypto wallets and will allow billions of users to actually use these protocols from their conventional systems, like your Gmail, or from your some Google account that you have from Google Maps and so on. Spend money very easily by using these distributed networks. So in my opinion, that integration of these CBDC stablecoins, trustworthy, and integration with corporations that I have a lot of users like Facebook and Google will help a lot with the development of kind of small ecosystem by now.
Yeah, I also agree with Leonid that the development of payment system through the stable coins is a kind of very important next step. So like we see this transformation happening, for example, fintech companies and neobanks, like for example, Robinhood on Revolut. So you used to have this service, like you can use your Revolut account to kind of purchase the Bitcoin, which is not the case because they don't technically give you this Bitcoin. They give you kind of a certificate representing that you hold this Bitcoin. And now they understand that it's not enough because people want to interact. They want to like put this Bitcoin as a collateral. They want to kind of get like the borrow for their needs or do other kind of transactions. And the kind of introduction of this stablecoin ecosystem and actually grow of this ecosystem will actually create a lot of opportunities for the financial intermediaries as well as the retail customers. I think the CBDCs is different, like from the stable coins, because stable coins are more connected to the organizations, communities, or centralized entities, while the CBDCs are actually the kind of national currency operated by the state authorities or central banks, which would be probably a closed ecosystem inside the country. But it's interesting to see how they kind of create the way how this ecosystem could be connected to the kind of borderless and international payments. That's interesting kind of development we will be seeing in the next couple of years.
Yeah, and I see that Michael is asking in the chat, are there any DeFi applications that could apply to equity markets, stock issuance, and ownership? Yes, there are a couple of ideas how you could be done this, how you could do this. So the first way is actually in order to use these equity assets in DeFi, there are a lot of problems with regulation because you need to issue an asset which has KYC AML procedures embedded. So the regulators for now will not allow to buy an equity regulated asset without the KYC, and DeFi protocols mostly work without the KYC provisions. But there are a couple of solutions for that. For example, there are some DeFi protocols that use synthetic assets. Synthetic assets is like a CFD, like a contract on the changing of the price, and you could actually execute some logic inside this contract to verify that the asset actually follows the price of the system is tokenizing. So there are a lot of projects like Synthetics or Mirror Finance or UMA protocol that are envisioning that at some point of time there will be a lot of assets mirroring traditional assets from the traditional systems, but they will be represented as tokens without the KYC provisions. But at some point of time, once we have some DID solution like decentralized identity, which will where you can verify your identity to a regulator without disclosing it. You can connect your identity to your wallet, and the wallet can hold these regulated assets too. So once you can kind of inform the government, like authority, that you are the person you are representing, that you are not a terrorist or so ever, you could have regulated tokens inside your wallet that can be used in this decentralized finance. And actually, at that point of time, a lot of issues would be solved with this infinite KYC AML procedures that regulated entities impose on users. So right now, it's mostly synthetic. It's mostly CFD contracts in a tokenized form in smart contracts. But later on, as we have some DID solution, there might be a time we can use these tokenized securities in regulated way instead DeFi protocols.
Okay, thank you, Geray, thank you, Leonid. Actually, I have one more question. So if I don't know anything more or less about this very sophisticated world, so as an investor, what are the ways I can earn, how much I can earn, and what are the main risks in each type of earning, how to say?
Well, I would say that the easiest way to earn value in DeFi is actually getting stable coins inside your wallet. The basic way to do it would be connecting to the Coinbase. Coinbase is the largest crypto exchange in the US. You could actually acquire some stable coins from Coinbase and withdraw it to your wallet. You can actually connect your wallet to the protocol called Compound Finance. It's a peer-to-peer lending protocol that gives you about 10 to 15% rate APY on your stable coins that you can actually earn value from the protocol in a fully decentralized way. And while doing that, you can actually receive some equity of compound token in the form of the governance tokens that would give you additional yield of 3.5% APY. So it means in total, by interacting with the protocol Compound Finance, you can actually earn about 18 to 20% yield on your stable coin. Bring the value from extract the value from the protocol and withdraw to your Coinbase account and actually pay taxes and be happy with that. And another way would be to speculate on the prices of tokens. So Ethereum has been on the rise lately. Bitcoin has been on the rise lately. So you can buy some of these assets, and you actually provide liquidity to decentralized exchanges and DeFi protocols, and not only speculate on the value of these tokens, but earn the fees from the traders who are trading one asset to another. So you can do that by just buying Ethereum with the stable coin 50%, put it inside the pool, and you will have the value growing as Ethereum is rising or as the trade exchanging one asset to another. So this is the easiest way to earn value in DeFi protocols. And Uniswap exchange is one of the DeFi protocols that democratizes this with IMMs, with these automated market making solutions. And a lot of exchanges that are copying the model of Uniswap that can bring you some more yield by rewarding you with governance token as well. So the easiest way would be the Compound Finance and Uniswap exchange as kind of fully audited and fully decentralized protocols to value from.
Thank you very much. There's a question from Elena in the chat. Actually, two questions.
Geray, do you want to answer that one?
The most promising technology in blockchain. So, if you know.
Yeah, it's actually currently kind of, it depends on the scalability of the network and kind of the adoption of the network, and also how it's incompatible with other networks. So many protocols and products are currently built on the Ethereum network, which actually shown the kind of sustainability, but it actually becomes the problem because of the high gas fees and transaction fees. So there are other kind of company networks which try to catch up and kind of introduce some low cost transactions and the ways to build some opportunities around this, but we haven't seen this yet. So I think the Tron and the Polkadot are doing the great job. But I would say that currently Ethereum kind of becomes the kind of showcase of the best applications available. And maybe Leonid could add to this some ideas as well.
Yeah, so in my opinion, basic entry for most of the investors in this area would be buying Bitcoin, because Bitcoin is a reserve asset like digital gold of these this digital asset space. So most of the funds, venture capitalists, are started by investing some amount in Bitcoin. And once you get the Bitcoin, you can speculate on other protocols and ideas as well, because they are all traded to each other on different exchanges. So the buy hedge fund probably bought some Bitcoin at the beginning, realized that you cannot do much with the Bitcoin right now besides of holding it, and they thought that investing their assets inside the growing protocols like Polkadot and Cardano, which are kind of right now, would be a good idea to get an additional upside for these from the value rising of these protocols. It's the same idea as an Ethereum. So a lot of investors bought into Bitcoin, but once they've seen Ethereum, they've been investing from 2015, and it played greatly for them, because Ethereum grew much strong through these years, like 5 years of development, and the utilization of the Ethereum network is very high, 100%. So a lot of users use it, and that's why the Ethereum asset is fueling the network is growing up. So that might be a good idea for a hedge fund to actually get an upside from these growing networks too.
Thank you, Leonid. So is there any other questions? So guys, please unmute and ask your questions if you have. There's a question from Dmitry. I'm testing your wallet now. Geray, so would you like to answer Dmitry?
Yeah. Hi, Dmitry. Thanks for using our wallet. So the idea behind Spatium is that we don't have a private key. So we actually, like what the blockchain needs actually, it needs your public address, it needs a kind of plain transaction data and the signature. So the private key is the way how you sign the transaction. So what we do is actually we replace the private key with the set of independent secrets, which never meet each other, they don't know each other, and then kind of the mathematical integration, mathematical interactions between these independent secrets create a signature the same way as a private key. So what happens when you actually register the wallet, you create your secret, which is accessible only to you, and then you basically control your funds with this secret. And there's another independent secret which is created on the service side, which acts as a confirmation secret. So every time you move the funds on the blockchain, we have two secrets involved in signing this transaction, and basically the confirmation secret holder doesn't have an access to your wallet. So you're the only one who actually keeps the full control. So there is no single point of failure in any part of this process. That's actually called secure multi-party computation, which is a kind of the advanced cryptography technology, which we implemented into the cryptocurrency wallet back to 2017, and actually we're the first company who did it using this technology.
Thank you, Geray. Some questions? Okay, so looks like presentations have been very insightful and covered all the topics. So no questions remain from the audience.
Yeah, Sam is asking a question.
Yeah. So this question from Sam. Yeah. When would you expect Bitcoin and other similar coins to be considered legal tender? Does it ever matter? Does it even matter?
Well, I think it matters because mostly Bitcoin and other crypto assets have not been used as a legal tender in most countries, because that is a bit disruptive to the current financial system, to the banking in particular. So in order to legalize Bitcoin and other crypto assets as legal tender, that would mean that banks are prepared to lose most of their business in the country. And it means that some of the deposits from these legacy financial institutions might flow out to this new crypto ecosystem. So I think that it will come with time, because users want it, and since the youth want all across the globe, it will happen. But it will not happen that easily, because the government wants to protect the citizens and the financial institutions that exist today from the collapse. Even CBDC, even countries, central banks that are using CBDC are considering the risk of financial institutions losing their customers and fully transferring their assets from legacy financial institutions to the central bank accounts. And that's a really a huge problem for them that needs to be considered very carefully. So in my opinion, that will happen moment when banking institutions will get integrated inside the crypto sphere. They start integrating wallets, start providing custodian services, and provide services needed for the users. At this point of time, government realized that it's actually safe to make a legal payment solution based on cryptocurrency. They will actually allow it. And in terms of adoption, I thought crypto will stay in the rise as nonetheless, because actually these transactions are very useful in peer-to-peer transactions too, in peer-to-peer operations. So once you want to send some money to other guy in other country without like buying something and just sending, it's very easy to do it with the cryptocurrency, and it cannot be stopped or regulated somehow. So you can actually do it freely. But once the safety of legacy financial system would be preserved, I think that governments will in any way allow to use them in legal tenders. I think the infrastructure till then will grow a lot, meaning that there will be a lot of safe wallets like Spatium or MetaMask or other service providers that will allow users to spend their currency without too much risk and at very cheap price. So at that point of time, the ecosystem will be ready to give the users what they want, and you would see in I don't know, in some shop in US or Europe that you can pay by card, or you can buy pay by Bitcoin or Ethereum on any stable coin on the market. I think that will happen inevitably.
Yeah, I agree with Leonid that regulators has to protect their markets. They need to protect customers and need to protect industry. So that's why actually they move a lot of functionality and design the central bank digital currencies, which can actually kind of play as a role of the kind of alternative mean of payment and to what exists in the countries, and blockchain, decentralized blockchain-based currencies like the Bitcoin, they kind of consider to be risky in terms of the managing and in terms of the volatility. So regulators actually have to consider all these risks, and that cannot be kind of transferred to the population. So certainly there's a way, there's a path we have to get through until the people kind of understand how these digital payments are done, how the wallets have to be managed. So there's certainly some routes and education which is required to to get kind of involved in the space. Yeah, so otherwise the Bitcoin will kind of continue to play a role of kind of store of value, and also kind of in alternative investment asset class for some institutions or investors.
Actually, I have a follow-on question, which also stays in my mind for some time. So I wonder, so for example, MicroStrategy have been investing in Bitcoin for quite some time, yeah, like half a year. But this is an IT company which provides some data processing software. Like Tesla bought Bitcoin recently. So how come that like public companies which are regulated by SEC or some other government institutions can actually freely buy Bitcoin, but can I, as a physical physical entity, can buy Bitcoin? So what is the legal background now? Is it legal? Is it not legal? So what I can do with Bitcoin, what I cannot do with Bitcoin, and what is the regulation or main regulation trends in different regions of the globe?
Mikhail, you can actually buy Bitcoin. There's no problem with that, and nobody can stop you. So that's the basic idea behind this. If it could be stopped, this transaction can be censored, there is no point in Bitcoin. So the idea that you can actually diversify, you can buy different assets on your balance sheet, you can buy currency, you can buy digital assets on your account in order to preserve some kind of an investment strategy that we have. In terms of MicroStrategy, I think that their strategy is a bit too rough, meaning that they need to sell the like their product that they're creating, not speculate on Bitcoin. So if you're just buying like 5% on your 5% of your balance sheets inside the Bitcoin, that's totally fine. But if you're heavily invested in Bitcoin, like, I don't know, 50% or 70% of your balance sheet, that might not end well, because the Bitcoin is very volatile, and you're not creating any value if you're just buying Bitcoin. You're not creating value here. You're just trying to speculate on the volatile asset, and I think MicroStrategy is not doing the right thing here.
Mm-hmm. As well as
yeah,
Tesla, because Tesla should produce cars and not buy Bitcoins.
Yes. So Tesla should produce cars. It should not speculate on Bitcoin mostly. Yeah. So they can diversify the investment strategy. They can put some free cash flow from their activity to Bitcoin. But filling your balance sheet like 70% in Bitcoin is just, I don't know. I think SEC might get here.
Yeah, just want to mention that Bitcoin is a regulated asset class in US, for example, or Japan, or most West European countries as well. So as long as you kind of pay taxes on your capital gains, there's no any issue to get involved. In Russia, it's different. But you still kind of can buy Bitcoin anytime you want. Like, you just simply can use as part of wallet for that. Like you can buy Bitcoin with your credit card. So that's actually accessible everywhere. There's no limitation, basically.
Mm-hmm. Okay, yeah, thank you very much. There's one request for everybody. So can you please turn on the camera for like a couple of minutes? So we would like to take a screenshot of today's event. So please do it for just a couple of minutes. And smile. Actually, if you would like to be on the picture smiling, so it's better you smile. Yeah, it's much more live this way. It looks much better. There's few people, so if you can also add turn on cameras would be really nice. So Jenny, did you manage to take a picture of our today event?
And you have been captured, and obviously this is recorded.
Mm-hmm. Okay. You can take it from recording. Okay.
I see Ruslan is on.
Okay. Okay, guys. So last chance to answer any questions if you have. And if there's no questions, we will have to finish today's event.